When the world loses confidence in the dollar, then they're not going to be willing to sell any of their goods for dollars. So it's really kind of two different answers depending upon whether we're looking at just purchasing power here or taking a broader look globally, the dollar against those other currencies. Because it's, regardless, it's all a race to zero because it's all on a debt-based system. And I can see a time, I definitely do see a time, where you'll have, the dollar will just be a local currency, not a global currency anymore. I mean, I remember going to France, and this would have been like in the 90s, and, that they preferred to get paid in dollars rather than francs at that point. It was the early 90s, so it was before the euro. And they wanted to get paid in dollars. Would they want to get paid in dollars today? No, they don't want to get paid in dollars. So there's two different ways to answer that. Either way, the dollar's value globally and locally is headed towards zero. Even though they'll come out with a new currency and it'll still be called a dollar, the digital dollar. But the dollar, the debt-based dollar that we have right now is 100%. It's headed towards zero and very close to that. I don't personally hold a lot of debt, and I could pay my mortgage off. I mean, it's small enough, I could pay it off, but I don't do that. Instead, the money that I would have used to pay that off, I've simply, as you know, put into gold. Mm-hmm. So when that reset happens, that overnight reset happens, and you see gold go up, then there's going to be a window where you're going to capture some of those gains and pay off that debt. So you just have to be paying attention, but you've got to have gold for, especially when you're talking, variable rate debt you want to get rid of, I'm going to tell you. You want to get rid of that and get rid of it now because we see what's now happening with interest rates. Mm-hmm. But fixed rate debt, why not pay it back with cheaper dollars? And there's no doubt about it. I mean, we just did a recalculation of the fundamental value of gold, a month or so ago? It's not necessary to do it constantly. But it was 13,500 or something like that. Mm-hmm. And spot is at like 1,900 and something. You can do the math. The whole world has agreed that this is money because it meets all the criteria to be a good money. So demonetize, no, they already tried that. Has it worked? No. Why are they accumulating it? Because it's money. Because it's good money. It's hard money. It's savings-based money. In my personal strategy, where I thought that I would convert, a chunk of it once there was a component of gold in the new currency, I'm not planning on doing that anymore because I'm not willing to give them that much control. Mm-hmm. So, I might do as much as I need on a monthly or quarterly basis or something like that. But because I don't want to give them total control. And the way to keep a level of control is to have real money outside of the system and then just put it into the system as you need it if you have no choice. So, yeah, you're not going to have, once they put the CBDCs in place, that will not fix the problem. Let me be really, really clear on that, because they aren't going to change behavior until they're forced to. And the only thing that's going to force them to change behavior is the loss of confidence of the public. Public says, I'm not using that currency anymore. I don't want to take it anymore. That's why you see them in Venezuela using gold and Zimbabwe using gold, using anything other than the local currency because they don't trust it. To be perfectly honest with you, the lion's share of my personal holdings is definitely gold. But silver is the secondary monetary metal. And for me, I think it's absolutely perfect as a universal tool of barter. Plus, it's easy to get them in different sizes, etc. So I don't stack platinum or palladium. I mean, I do own some platinum, but I definitely don't stack it. I just stack gold and silver. Russia creating a petro ruble or a gas ruble, however you want, a commodity ruble. But the other thing that they're doing is putting a floor underneath the price of gold. So they're doing two key pieces. Now, the US dollar officially in terms of purchasing power is already at 3 cents. And with this rapid inflation, approaching that 0 point very, very quickly. But it really is all based on confidence. So how long before the US dollar goes to zero? Well, we're pretty close to that now, and I can't give you a specific date because, again, it's just based on the confidence that the world has in the dollar. But there are a lot of things that are happening that would definitely indicate that the US is losing its position as the world reserve currency so soon. That's the best date that I can give you. I don't know exactly when. Anybody that's holding dollar assets can make that deposit into that substitution fund, and then those would be converted to SDR, special drawing rights, which is the currency of the IMF. Now, the consequences of the precious metals are huge because right now, as long as people have maintained confidence in their currencies, whether it's the dollar or the euro or the yen, depends on where you live. But as long as people maintain confidence in the currencies, then it benefits governments and central banks to suppress the visible price that you see in gold and silver, because a rising gold price is an indication of a failing currency. But when that confidence is lost and they have to regain that confidence, that's when you will see the gold and silver, but mostly gold because that's what they reset a currency against, go to that fundamental value. So the consequences is much higher from here. You know, right now when you watch on TV, like you may have noticed that the ruble lost a lot of value against the US dollar, and now it's back to pretty much where it was. So that's one measurement, and that is frankly typically the only measurement that they ever talk about on, you know, CNBC and Bloomberg and the newspapers and all of that. So it's just one currency that's purchasing power is headed to zero against another currency whose purchasing power is headed to zero. I'm pretty darn sure that if we had the ability to talk to just a normal average Russian citizen that's living there right now, they didn't suddenly match.
The unallocated London gold market, it's not appreciated that much. That basically gold, you know, Paul Volcker in the 70s said gold is my enemy, right? Gold is the enemy. Gold, it's not the enemy. It's like saying a thermometer in Arizona in June is the enemy. You know, it's not the enemy. It's just you're in Arizona in June. You know, it's friggin' hot. And so in the same way, the way central bankers have managed, you know, it was their enemy because they would have to tighten rates when they didn't want to tighten rates. Right? It was forcing them to actually exercise discipline. What they have done to control these markets has been to allow the robust expansion of paper gold. Unallocated gold in London in particular, where there are unallocated over-the-counter claims, who knows, it's been estimated anywhere 20x, 50x, 100x, 1000x, nobody knows. Mm-hmm. You have some guesses, they're all guesses. COMEX also, it has gotten more paper driven. I mean, I had one of the biggest physical gold traders in the world tell me, I think 4 years ago, that, you know, when he started in the business 20 years prior to that, you know, probably 20% of the volume on COMEX in the gold markets was at least related to a physical ounce. He's like, that's now probably 2%, and the volume's probably risen 3, 4, 5x. So they've basically, it's not the same thing in COMEX as it is in unallocated, but the bottom line is if you have inflation, and that inflation drives in monetary inflation, you expand the monetary base, you run big deficits. If that drives gold demand, there's two ways to deal with that gold demand. You can let the price of gold rise, more dollars chasing the same gold price up, or you can let the number of paper claims on gold ounces rise. And that way, with that, you can manage the pace of gold's rise. That's what they have chosen to do. That though, is the weak link, because if you look at COMEX inventories, a small hedge fund could go to COMEX and say, I want to take all of it and break the market. The fact that they don't, there's an extraordinary informational value that most people just ignore. The fact that some small hedge fund hasn't gone and created a short squeeze like they did in AMC or like GameStop last year, right? Why not? The why not is because you get talked to by someone who has haircuts like ours, and they're like, you don't understand. That's not going to happen. We're going to cash settle you, and you will be persona non grata, best case. And that's just, again, this is statecraft. Gold is not just some free market. It is a political metal. And so now, if you're going to do that, if you're going to do the Hunt Brothers short squeeze, right? I'm not speculating. The Hunt Brothers tried this in silver in 1980. The system has to protect itself. The Hunt Brothers were not a sovereign. The Hunt Brothers were not the biggest oil exporter in the world, like Russia is. The Hunt Brothers did not have nuclear weapons. The Hunt Brothers did not have an army. The Hunt Brothers were not closely allied with China, who's the world, so on and so forth, right? It's a very different game at that level. And that's why I say people underappreciate the leverage that the energy that Russia has as their real currency could be. What if Russia comes out and just says, listen, we and China have agreed that to get around sanctions, we are going to transact in, we're gonna settle gold, or oil, excuse me, in physical gold at a new ratio of 1,000 barrels per ounce of gold. And everyone is going to go, oh my God, this is a great arbitrage, right? I'm gonna go buy 1,000 ounces of COMEX gold or GLD, and then I'm going to convert it to physical, and then I'm going to take the physical over to Russia, and I'm going to get 1,000 barrels of oil, and then I'm going to sell the oil, and I'm going to get rich. And the market properly is going to shut down. It's going to crash instantly. The paper gold markets will just go boop, cash settle everybody, game over.
And you brought up chapters 1 and 2 from Currency Wars, where you basically highlight this scenario. You said the scenario you presented at the time was that Russia and China would accumulate large gold reserves, pool their gold, and launch a new digital currency backed by gold in the place of the US dollar. Is that the form it would take for you, something backed by gold?
Probably, and here's why. And by the way, when I wrote that, and when we did the war game, and when I wrote that, Russia had about 600 tons of gold, and today they have 2,300 tons. China had about 600 tons of gold, and today they have about 2,000 tons, just slightly less, that we know of. And they may have several thousand tons off the books in the State Administration of Foreign Exchange that we don't know about, because that's completely opaque. So Russia and China did exactly what we warned the Pentagon about in 2009, exactly, which is increase their gold reserves by a factor of 4 or more. But everyone's like, well, the Chinese yuan is going to be the global reserve currency. No, and it's not going to be the ruble. But here's why. Well, there are a lot of reasons, but the main reason is, when you talk about reserve currency, you have to understand what that means. It's not like the People's Bank of China has a bunch of $100 bills on pallets stacked up in the basement. When people say reserve currency, what they really mean is the currency of the bonds that they invest in. In other words, they're dollar-denominated assets in the form of treasury bonds or notes. That's what China actually has on their books, not like the dollars per se. So if you want to suggest or hypothesize that the Chinese yuan is going to replace the US dollar as a global reserve currency, where's the yuan bond market? I mean, it doesn't exist. Very small scale, very illiquid, no primary dealers, no win issue trading, no auctions, no repo, no settlement clearance, none of the plumbing and the mechanics of a mature bond market such as the United States. And above all, they don't have a rule of law. I mean, at least if somebody reneges on a treasury bond, you can sue somebody, but you can't do that in China. So the absence of the rule of law, number one, the absence of the infrastructure, the plumbing, for want of a better word, are two reasons why the yuan and certainly the ruble will not replace the dollar as a reserve currency. However, what I was hypothesizing then, and I would come back to this, is you can create a brand new currency that does have all that stuff. And in my example, they used a Swiss bank, UK law, put the gold in a third-party depository. If you wanted some of the new currency, you could deposit your own gold and get some of the currency or trade with them or run a surplus. So it was a replacement system, but you would need the gold to instill confidence. But they don't have bond markets, and they're not going to have them soon. So the yuan and the ruble aren't going to replace anything.
I guess to wrap part one of this very thorough discussion, I want to get back to really the main point you're hammering home here, is that we're on the verge of a global liquidity crisis. How does that domino effect play out? How far are we from this really erupting to that global crisis, Jen? Does it happen exponentially from here? Does it take a few years? Where are we at?
It's more the former. We are uncomfortably close. Now, it's impossible to know exactly how close because it's a complex dynamic system, and you can make very good predictions on complex dynamic systems as to the magnitude of the crisis, but it's very hard to get the exact timing. But because you never know what thing is going to trigger it. But I can say that we're uncomfortable because now we've been there twice before in recent years. 1998. We came within hours of shutting every market in the world. Began with a Russian default, by the way. August 17th, 1998, Russia defaulted on their external debt, and the ruble was grossly devalued. That started a global liquidity crisis, went around the world, ended up in my lap at Long-Term Capital Management, where we had $1.4 trillion of derivatives. And everyone goes, oh, long-term capital, you guys lost a lot of money in Russia. We didn't. We lost maybe $100 million in Russia, but we lost closer to $4 billion on everything else, because in a liquidity crisis, people sell everything. It's not a question of, do you have Russian bonds? It's like, no, they sell everything. Spreads widen. Not enough collateral, margin calls, people being blown out of their positions. That's what a global financial crisis looks like. We cured that with a $4 billion all-cash injection sponsored by the Federal Reserve and two rate cuts, one on an emergency basis by Alan Greenspan. We got through that, but we came within hours of shutting every market in the world. Same thing in 2008. We all know, September 15, 2008, Lehman Brothers. Okay, people don't realize that Morgan Stanley was days away from failing. Goldman Sachs was days away from failing. John Mack said so at the time. Lehman was begging for help. He said, "Sorry, I got enough on my plate. We're worried about Morgan Stanley right now." And then the Fed came in, and so think of it as dominoes are falling. So all the dominoes are falling, and they're going to keep falling unless you truncate it, drop a wall in, and that wall was the Fed. But here's my point. Each bailout gets bigger than the one before. Each crisis is more dangerous than the one before. So 1998, 2008, here we are in 2022. We're going to get to a point, we may be there, where the crisis is actually bigger than the Fed, bigger than the Fed's ability to stop.
The silver squeeze, as we've discussed before, or what's commonly called the silver squeeze, which is millions of retail buyers buying silver, netting silver to their portfolio, has been important, I think. But the real silver squeeze, from my point of view, comes about when the largest institutional investors in the world recognize that the 40% of their portfolios that they have involved in debt instruments needs to be changed. 40% of institutional portfolios aren't performing, and the institutional managers are going to need to change their investment behavior. And I believe that some amount of that money will find its way into the silver market. And I don't think that there is sufficient silver, or certainly silver equities, to satisfy that demand. Specifically, and we've talked about this before, the market share of precious metals and precious metals related assets in the United States market for savings and investment is less than 0.5%, which is to say 0.5% of the savings and investment assets in the United States market are made up of precious metals and precious metals related securities. Historically, the mean valuation of precious metals and precious metals related assets, or put differently, the market share, has been between 1.5% and 2%. At the very least, over the next 5 years, I think that precious metals will return to mean, which means that demand for precious metals and precious metals related equities in the United States market, the most important savings and investment market in the world, will triple or quadruple. In my heart of hearts, I don't think that we're going to have reversion to mean. I think that we're going to overshoot mean, but I don't need to overshoot mean to make my case. A circumstance where the Harvard University Endowment, the Stanford Endowment, Teachers Investment and Annuity, the Saudi Sovereign Wealth Fund, the Chinese Sovereign Wealth Fund, Norges Bank, to the extent that the largest institutional investors in the world increased their holdings in precious metals from 0 to their 3-decade mean, would lead to a tripling or quadrupling of demand for silver. And that would be a real silver squeeze, a real silver squeeze, a squeeze of a dimension that I don't think that we have seen since the 1970s, a squeeze that would in fact put the efforts of the Hunts in the 1970s into proper perspective. You know, 3 fat boys from Dallas did a pretty amazing thing to the silver market, but nothing compared to what the largest insurance companies and endowments and pension plans in the world will almost necessarily have to do over the next 5 years. I see the need for a behavioral change among individual investors, which would mean that I see individual investors abandoning the course of action that they've adopted over the last 40 years. I think one savings class for individual investors needs to be a medium of exchange that's simultaneously a store of value, which is to say silver or gold. I want to see real rather than fiat liquidity in individual portfolios. And I think that the silver squeeze was very useful in that it taught 1 million young people that they need to have an asset in their portfolio that isn't simultaneously somebody else's liability. That is classical money, which is silver. But the other side of the silver squeeze, I think, will make more impact on the price, which is to say very large institutional investors. Let's look at Norges Bank, Sovereign Wealth Fund of Norway. Their net asset value is now well over $1 trillion. And their holdings of precious metals and precious metals related assets are, to my knowledge, 0. If Norges Bank were to allocate 3% of their assets to precious metals, that would generate, by my calculation, about $30 billion worth of buying. That's the stuff of the silver squeeze. That's $30 billion worth of buying from one motivated buyer. Extend that to Abu Dhabi Investment Corporation, to CITIC, to Kingdom Holdings for Saudi Arabia, to the Stanford University Endowment, to the largest insurance companies in the world, and you understand the probability of a quantum increase in demand for precious metals as a consequence of disintermediation out of debt instruments, where these largest institutions of the world are 40% invested. That's the silver squeeze that I see.
So I do just a basic, easy calculation. Okay, what's the fundamental value? What's the true value of an ounce of gold for its most important function? And in my opinion, the most important function is to hold your wealth, your purchasing power even. Does many other things, but that's the most important function. So if I know for an absolute fact that the true value of an ounce of gold is $50,000, then quite honestly, I haven't really spent 50,000 on a coin, but I'm just saying, I do know that the minimum fundamental value of an ounce of gold is 50 grand. So if I spend anything less than that, and it's on even a high collectible, my bet is hedged.
You described Bitcoin and cryptocurrencies as almost like an ideal training ground for, so why would the US government allow, such freedom of owning cryptocurrencies competitive to the US dollar? Well, because this is an ideal training ground to train the public to become accustomed to a digital currency so that when they roll out their government issued digital currency, we already understand how they function. Whereas if we were just hit with this cold turkey, moving from paper money to a government issued digital currency, we'd all be like, well, I don't understand this. What is this garbage, right? Like, I don't.
Here's change. Oh
Yes.
my goodness. Because one thing they knew, and then you did it great. One thing they knew when they set up this whole system is that, people marry the legal money of the state. And so what they say in their documents, so I'm not making this up, this is what they say in their documents, anybody can read them, is that they need to keep the new currency as close to the norm that people are used to as possible. And that's what happened in 1971, right? And if you look at the bills, they look really identical. It's very subtle. So people did not know of the change. Now, I think it's coincidental that in 1996, the NSA did a white paper, government agency, did a white paper on how to create a mint, outlining how to develop the cryptocurrencies and the market. Then in 90, I think it was 7 or 8, there was a peer review paper on smart contracts. Bitcoin came out in January of 2000, and I've been watching it since it was $7. One of my clients said, "Hey, look at this." So Bitcoin came out in January of 2009. What else? Where were we in this trend cycle? The system died in 2008. Hello, it died, right? And then in March of 2009, the Federal Reserve began this next major experiment in quantitative easing, which is just massive money printing to massively devalue the currency. Is that a coincidence? I don't really believe in coincidences, if you want to know the truth. So yeah, that is my opinion of it. And I will say the people that buy the cryptocurrencies and the people that buy the gold have a very similar mindset. They're really unhappy with what they're seeing, and they want a decentralized private place to hold wealth. I get that, and I really do get that. But I don't think you're very private with Bitcoin, because what do? When you open an account, don't you have to give them your name, address, social security number? And they were supposed to not be able to, on the blockchain, that was supposed to be a permanent transaction. And yet recently, haven't we seen some money being clawed back by the government in Bitcoin from people that had taken it? So that means that's not really true, right? It's not immutable. They can claw it back. So it's not private. It is decentralized, except that it has to go over computer systems. And the IMF did a piece, it was like 2017, AC chain tied. This is a new, bear with me here. I'm going back in my memory here for a second.
Yeah.
But they came out with a new cryptocurrency, and their currency was tied to Bitcoin and then went through these nodes. And one of the nodes was that it went through the IMF. Now, in another paper, and it converted into an SDR, right? So when it was matched with, their coin was matched with Ethereum or Bitcoin, then it turned into an SDR, and it went through the IMF node. Now, they had a paper on, the IMF had a paper on how every title to every asset would be held in digital form. And then it would be broken down into itty bitty pieces. And if you're holding all of your data and all of your wealth on phone, which makes it super easy to spend, and you are inspired to buy that boat, and you have equity in your house on your flipping phone, that will inspire you to spend your equity. And before you know it, you will own nothing and you will be happy.
We need something that is a neutral reserve asset, because I think the way Keynes described it during Bretton Woods, and I've heard the IMF say that several times. So I guess it's about the world moving to a neutral reserve asset that isn't controlled by any country, and you think that's going to be gold. So I think that's your end game. Can you go ahead and maybe give us your version of that?
Yeah, I think at least in the intervening term, it's gold. I mean, it could. There's no reason it couldn't also be Bitcoin, something like Bitcoin. But that's right now, gold's on central bank balance sheets. Bitcoin isn't. So we'll see how that develops. But I think when you look at the combination, the fundamental problem is that in order, peak cheap energy combined with the sovereign balance sheets of the world, in particular of the West, and in particular the reserve currency issuer US, means that in order to keep treasury bonds, and we'll pick on treasuries because it's the reserve currency issuer, Europe has some similar problems, but to keep treasury bonds nominally AAA rated, you can't by definition keep them AAA rated on a real basis, particularly in oil terms, right? So basically, peak cheap energy means it's getting more and more expensive to grow and find the marginal oil barrel. That's likely to continue. And while there are some alternative energy things we can do, the fact of the matter is oil and gas are still, 70–80% of our global energy consumption. And that's not going to change in a time horizon that I think is relevant for this discussion. So oil's going to keep getting more expensive if you take out sort of, cyclical moves, right? So oil's going to rise, which means treasury bonds, particularly with rates at 0 or 25 basis points after today, I suppose, are going to lose value against oil just on the geology of oil alone.
Right.
Then when you take into account the sovereign balance sheets of the West, of the US specifically, you have this situation where they can't afford to let rates rise very much to compensate you for the rising energy costs. And so they're going to have to basically at some point grow their balance sheet to, they have to keep real rates significantly negative. And we've seen that. And you and I talked a year ago and I said, look, I think real rates are going to at least -5, maybe -10 or 15. And people at the time were kind of laughing. And of course, they're not laughing now. Here we are, -8. So it's this fundamental problem where to get the West out of the problem they are with their debt load, particularly in the context of a peak cheap energy world, you've got to have significantly negative real rates, but that, and particularly in energy terms, but that doesn't work if you're a creditor. That means basically you have an ice cube of savings that's melting away at 8 to 10% per year in energy terms, which really matters because if you don't have enough energy, you're going to starve, economy collapse, a whole slew of bad things that political leaders will do.
Luke, why don't you give an example of a country that would be applicable to? Because I think that'll help the listener kind of get their mind around what you're saying. So if you're a country, I think the way you termed it with Grant is if you're long dollars and short energy, then
you're China.
You're holding onto those dollars in treasuries. And if the treasuries have a negative real yield, then your purchasing power or how many barrels of oil you can buy with those treasuries is decreasing, and that's bad news if you're a Japan or a China.
Japan, China, Europe, and quite frankly, it's bad news for Russia too, right? You sell a bunch of oil today at 100, and then in 10 years it's 400. You would have been better off just leaving it in the ground because you're not going to get compensated with interest with rates at 0, and the U.S. can't let rates rise enough to to do that. So that is both sides of the coin. It doesn't work for anybody. It doesn't work for the U.S. middle class or working class. It only works for sort of this narrow set of interests that are closest to the dollar system. So I think what we're seeing is the system feeling itself out, the different players trying to enforce their desire to move to a system with a neutral reserve asset, right? Because at the end of the day, gold is just a 0% yielding bond, right? Okay, so Treasury is 0% yielding bond, gold is 0% yielding bond. Gold is infinite duration, Treasury is finite duration. Gold is finite issuance, Treasuries are infinite issuance. And gold has an infinite face value and Treasury has a finite face value. And you could use apply some of these same things to Bitcoin, and it's even more attractive, I think, on the issuance side than gold is. But the point is that in the situation where we are with energy, with sovereign debt where it is, you need to move to a system with a neutral reserve asset. And if you don't do that, volatility is going to rise, and the system's going to you're going to increasingly see commodity producers decide, I'm just going to leave it in the ground. I would rather have oil than treasuries, so I'll just leave it in the ground. I'll take out what I have to take out and to pay my dollar debt, and anything else I'm going to leave in the ground. And the system will break down.
One point that I would make is that when you say this is the highest inflation since 1982, 40 years basically, that's true. But the inflation in 1982 that we're comparing it to was the end of the inflation. It started really in a severe form around 1976. And so by 1982, it had come down to 7.5% or thereabouts. So you're right about those numbers. But it was up to 15% in 1980. So 7.9 or whatever the last number was in terms of the monthly inflation figures, yeah, that's pretty bad. But don't think it can't go a lot higher. It can. What I expected, and I still expect this. Let me put it this way: I still expect this, but I pushed out the time horizon because a lot has happened and we have more data. There are two kinds of inflation. And one is what they call cost push inflation. The other one is demand pull inflation. Those are economic jargon. But demand pull is when it's driven by the consumers, the everyday American or everyday person around the world. They see some inflation. They go ask the boss for a raise. They go, hey, I need more money to keep up. They accelerate purchases, like, gee, if that refrigerator is going to be more expensive 3 months from now, maybe I better buy it today before the price goes up. It kind of feeds on itself, but it's very much driven by consumer behavior, the behavior of labor and working people, trying to keep ahead of something that they're living through. So that's demand pull. The other kind of inflation is called cost push. That comes from the supply side. That basically is, an oil embargo or a war in Ukraine or economic sanctions or supply chain disruption. There could be a lot of causes or multiple causes, but basically it's not that the consumer has so much changed his or her perspective, but they can't get stuff, or the suppliers are raising the prices because, hey, our input prices are higher, so we have to raise the prices to consumers. Now you can have both. One can feed. It can start as sort of cost push, meaning it starts with supply chain disruption, comes from the supply side, but then the consumers say, "Hey, no mas, enough. I want to raise," and so it can feed on itself. The reason I make that distinction is because the Fed can possibly do something about the demand side. The Fed can, squash it by raising interest rates and raising mortgage rates and deflating asset values, et cetera. The Fed can't do anything about oil. The Fed can't do anything about the supply side. They maybe people think they can, but they can't. And that was what we saw. That was how it started in the 1970s. It started with the Arab oil embargo, which went through two separate phases. One with the Arab-Israeli war, and then later with Iran. We had two separate, periods of spiking gas prices and gas lines in 1974, again in 1979. But that started from the supply side that the Fed couldn't do anything about. Although the Fed probably was too easy at the start of it. So right now, this inflation has come from the supply side. Now, how will it play out on the demand side? That's the question.
That's interesting, because I had one professor of applied economics on saying, look, this inflation has nothing to do with broken supply chains, etc. It solely has to do with money supply and the surplus of it. So would you say not so to that?
Is that Professor Hankey or?
Yes.
Yeah, I know Steve. I have 2 degrees from Johns Hopkins, so he's very much a. Yeah, Steve is brilliant. Great on foreign currency, great on currency boards, and a lot of other things. I completely disagree with that description, and I'll tell you why. And I've said this before. The Fed has exploded the money supply, so there's no question about that. M0 has gone up by 400%. The Fed's trying to rein it in a little bit, but when you go from 800 billion in 2008 to 4.3 trillion in 2013 when they started the taper, to 7 or 8 trillion, which is where it was after the pandemic in the spring of 2020. There's no question about the money printing, but that money doesn't go anywhere. It doesn't do anything. It's basically the Fed expands M0 by buying bonds from the banks. They take the bonds on the portfolio, they give the money to the banks, money comes out of thin air, but the banks just give it back to the Fed as a deposit in the form of excess reserves. So you're inflating the liability side, which are the excess reserves, and the asset side, which are the bonds. You've inflated your balance sheet, you've increased M0, but you haven't done one thing for the economy. There's nothing about what I just described that goes into the real economy. Now, where does money for the real economy come from? It comes from commercial banks lending and consumers spending, and that shows up in velocity. And if you look at the velocity statistics, they've crashed in the last 10 years and they're still going down. So the reason so-called money printing doesn't turn into inflation is because the money doesn't go anywhere.
Do I believe that an economic slowdown would result in a new wall of money? Yes, absolutely. The big thinkers of the world believe that they can control human action with liquidity, and thus far they've been right. The thing that you need to worry, let's do that last. In terms of their ability to raise interest rates, right now, they've been able to do it, and they need to do it. In order to lower interest rates later, they need to have them up now, and they will continue to raise interest rates as long as they can get away with it. My nervousness is that we as a society have grown accustomed to free capital. It's a different way of saying that we believe that we're justified in consuming our seed corn now. What artificially low interest rates and debt and deficits really are is a transfer of wealth from young productive people like you to old lethargic people like me. And that's okay with me as long as it's okay with you. But when it ceases to be okay with you, it's going to be problematic. As we raise the interest rates to the extent that a sclerotic economy can't afford higher interest rates, you will see the interest rate fall very rapidly. The scary part, Jake, I'm interested to see it occur, but I'm afraid to be around if it does occur, would be a circumstance where they printed a wall of money and savers went on strike. Suppose they gave a treasury auction and nobody came. Suppose that the US Treasury had to buy the whole issuance itself, which is to say, rather than hoodwinking savers for 65% of the Treasury auction, printing 35%, that they had to print 100%. Suppose there was a broad realization among savers that the currency was a fraud. What implication would that have on markets? I hate thinking about it, but making myself think about it is one of the reasons why I want to have ample liquidity, and one of the reasons why I want some of that liquidity to be in gold. which is, after all, not merely a medium of exchange, but also a store of value, not merely a promise to pay, but payment itself. I'm one of those, Jake, that when I ask myself the questions that you answered me, hope, first of all, they don't live long enough to see the answer. But I also really hope, with regards to my gold holdings, that form of insurance doesn't pay off, because the circumstance where there was a total repudiation of fiat currencies, but where savers really came to understand the fraudulent nature of the US dollar and other fiat currencies, and the fraudulent nature of treasuries, the era that would usher in would be pretty scary.
We're all experiencing a huge amount of inflation right now, although that it's going to get worse. There's not one doubt in my mind, I can't guarantee this, but I'm pretty darn sure that we are at the beginning of a hyperinflationary event. And the only difference between inflation and hyperinflation is the speed of that inflation. The problem is that there's virtually no purchasing power left in the US dollar. Now, and people go, oh, you're crazy. I still use that when I go to the store and I buy stuff online, etc. But if you go on the Federal Reserve's website, the FRED, F-R-E-D, and in the search bar, you put in purchasing power of the consumer dollar, what you'll see is that there's officially 3 cents left out of the original dollar's worth of purchasing power, which means it's worse than that. And all of this inflation that we're experiencing, we are losing rapidly whatever little bit of purchasing power is left. And so the bottom line to all of that is that we are at the end phase, the end of this fiat, this government debt-based money. And that is one of the patterns, is very high inflation. Like your viewers may have seen on, the talking heads on CNBC or read in the paper that it's like the 70s or it's like the 80s, and they'll go back, wow, this hasn't happened since 1974. Well, we were shifting at that point from a gold-based currency into a debt-based currency. One of the other repeatable patterns is the war. So if you'd been watching my work, I've been saying that, because wars always accompany these currency regime shifts, because now you're looking over here and then the war can justify this huge spike in that inflation. We also have civil rights movements. The oil, back in the 70s, it was the oil embargo. You indicated that Russia was talking about selling their oil for gold, but they're also talking about selling not just their oil, but possibly all of their largest exports in rubles. So creating like a petrogas ruble, right? Which is what the US did with the petrodollar back in the 70s when we were losing our status as the world reserve currency. So there are what the world has now seen the US do to Russia and the allies as well is cut them out of the global system. So any of the wealth, any of the assets that the government or a lot of the oligarchs in Russia held outside of Russia, they don't have access to it anymore. Because here's a simple fact. If you don't hold it, you don't own it. But everybody's watching that. So that's on a global government scale, but didn't Canada just do the same thing to their citizens? that were protesting and they didn't like it. So boom, they just cut them out of the system just like that. And they're still not back into the system. It proves that you better have resources, real money, that is in your possession if you want to weather this financial storm that we're in, because it's not going to be so easy. And some of your viewers may have already noticed that there are greater limitations put on your access to your funds. Maybe you haven't noticed that yet, but go and try and wire over $10,000 or $100,000 or whatever it is. Go and try and take cash out. You're going to discover that it's not really your money. They're going to say, what do you want this for? Why is it your business? It's their business because it's their money. When you make that deposit, you give them that. You loan them that money. So don't find this stuff out too late when you're locked out of the system and you can't access your wealth. Prepare now. Get ready now if you haven't already done so.
In 2008, Hank Paulson reportedly got down on his knees and begged Nancy Pelosi for the bailout, if you remember that, right?
There will be no cash in the ATMs by Wednesday.
No cash in the ATMs, no cash, tanks in the streets. He was worried about credit markets breaking down and then supply chains breaking down after credit markets. Much of Wall Street is sitting there looking at credit markets going, okay, a little bit of strain, but not too bad yet. But the supply chains were broken starting before this thing. You know, but it was the China stuff was broken, right? But there was not really there were problems with the food supply chains, but there were not problems with a capital P with the food supply chain. And now there is. And so I think we're seeing the crisis work in reverse, where this is not anything like the last 40 years anybody's ever seen, and so they're not thinking about it properly, which is you've broken the supply chains first. You're going to have a credit crisis because the supply chains broke first. It's not going to be, we have a credit crisis, we have to stop and paper over before it spills into supply chains. It's going to work the other way. And so I think actually you're seeing nations that are saying we're stopping exports of grains. These are the people that don't have any margin for error. I'm going to get thrown out of office, and that's the happy ending. In some places I will get, killed, literally, if there are food riots, etc. in my country. We're done here. We're not exporting as much. Either they slow exports or they put export taxes on it. They do something to restrain the outflows of grains. And so everybody starts doing this. These are people that are acting with a large margin of error, right? They don't need to day trade and get every last point out of corn. They just, boom, we need to make sure we have it. And so I think this is the leading indicator of this crisis, where as the recognition in credit markets dawns, you're going to have inflation continue to rise. And as you have inflation continue to rise, the supply chains break down, you're going to have this reinforcing mechanism of my fiat currency doesn't buy me what I thought. My fiat inflation, bonds, sell my bonds. I need to. And once that takes place, and I think it's starting to, central banks are going to have to, they're going to have to either stand aside and let this credit crisis evolve. And what's going to be really unique about this, in my view, is that it's, in the West, it's going to look a lot like an emerging market credit crisis, where yields go up even as stocks go down, asset prices go down, unless the central banks come in and cap yields and say, listen, all right, fine, 10-year treasury in the U.S. isn't going over 2.5 or isn't going over 3 or whatever. They will, we're doing QE, we're going to do some sort of yield curve control. And there's already calls out there, it started last week, for some sort of treasury liquidity facility from the Fed. It's not QE, it's a treasury liquidity facility. It's the same thing. because the Treasury market, the deepest, most liquid market in the world, not trading like the deepest, most liquid market in the world. You're already seeing these strains again, similar to what we saw in March of 2020, when the Treasury market, after 12 days of an equity downturn, crashed alongside stocks, which had never happened in 40 years. It was a huge, huge warning signal. It's flashing yellow again. And so I think what we're looking at is ultimately this crisis spreading from supply chains into credit markets, and then from there, the central banks, the Fed, are going to be forced to increase liquidity, increase balance sheets into an inflation spike. And that, I think, is going to be sort of the crisis that forces these politicians. First, I think, midterms here, I think the Democrats are going to all get thrown out. Anyone that can get thrown out of office, I think, is going to get thrown out of office at this midterms. And then you're going to bring in a new group of people, and will they get the message of like, hey, inflation's going crazy, what do we do? And Fed's going to go, look, Treasury market's not functioning. We have to keep doing this unless you want rates to go up. In which case, okay, it has to come from policy. What's the policy that's going to fix this? All right, somebody call the energy guys. What do we got to do to get gasoline back down from $7? Oh, we need to drill more? Okay, let's do that, right? I mean, you get the right group of people in there, they'll be, as a friend of mine says, they'll be drilling in Thomas Jefferson's nose on Mount Rushmore, right? Right. But until then, it's just the way our political system works. Until there's enough political pain to elicit a response, here we are.
The first one's not a financial reset. The first one is a man-made reset. In other words, it's an edict. It's a reset where those in power still retain power. But the first reset will be somewhat like moving the deck chairs around on the Titanic. It won't work because the currencies themselves are still fiat, and we're going to have to get to the point where currencies there's confidence in currencies because they have real backing. And I guess another way to explain it is, right now, if you sell an ounce of gold or you sell an ounce of silver, you're going to get dollars for it, or you're going to get yen or euros or pounds or rubles or whatever, but you're going to get paper currency. So you're back in the system. The second reset, that's when people, at this point, there's no sense in selling your gold or your silver because you're not getting anything real in return. But upon the second reset, once there's a currency that can be trusted, that is backed by something real, and more than likely gold/silver, then yeah, you can, with confidence, liquidate your gold, put it into currency, and then use your currency for whatever you need it for. But the point being, you're not going back into the frying pan of a fiat. You're not giving something away that's real for something that's fake. You're trading something that's real for something that's backed by something real. Very similar to what the United States had before 1933 when we were on a true gold standard. And I mean, there's been talk for quite a few years that they're going to try to do it with the SDR, and the problem with that is the SDR is what? A basket of fiat currencies. Whatever the first reset is, it will not hold because it's not going to truly be a reset. It'll look like one on the outside, but the guts of it will not truly be a reset where somebody goes to work, gets paid at the end of the week, and they get something that's sound money, if you will. Everything financial is worth nothing. And the reason being, I mean, look at a 30-year treasury bond or a 10-year treasury bond that pays less than 1% or pays 1.5% or whatever. If interest rates were to move just 1%, it would destroy the value of these things. And during the time period or the term of the bonds, what do they promise to pay you? They promise to pay you dollars. And you just got done saying that since January of 2000, the dollar has lost 87% of its purchasing power versus gold. So if you bought a 30-year bond in 2000 And back then you probably had, if my memory served me correctly, you probably had a, 5% or 6% yield. So yields have crashed and the bond has gone way up in value, but in dollars. And those dollars have lost 87% of their purchasing power. So unless the bond has gone up 87%, which they haven't, you've lost purchasing power, even though on paper it looks like, wow, it was a home run. So that's what I'm talking about, is that everything financial that promises to pay you in fiat currency is going to be wiped out for two reasons. And the two reasons are, when interest rates do finally normalize, because you have to, in order for a currency to truly have value, you have to be able to lend it and get paid interest on it. And that's not the case today. And then the other part of the equation is that when interest rates do normalize, the entire credit structure is going to be crushed. If pension plans across the board were to try to put 1% of their assets into physical gold, they would completely dry up the market. There'd be no physical, there wouldn't be any physical to buy. They'd clean the supply up.
Yeah, that's a crazy scenario to think about. And all of these factors kind of lead me to something that your partner Jim Sinclair came up with, is GOTS. Can you tell us what that stands for and a little bit about it?
Yeah, Jim came up with that, thinking it was back in 2004 maybe. It stands for get out of the system. And what he was and is an advocate for is basically getting your capital under your own control, whereas you don't have the liability of someone else. If they go bankrupt, you lose your money, i.e. your broker. If they're holding your stocks and they go bankrupt, it might take you 5 years to get your stock back. If you have an annuity and the insurance company goes bankrupt, what does that mean to your account, or what does that mean to your monthly check if that's what you're taking? In other words, he was an advocate of, if you own stock, have them issue the certificate so you have it in hand. That's your proof that you own it. And the entire world could go bankrupt, but you're still that portion owner of whatever company that certificate represents. And as far as gold and silver, you don't purchase gold and silver and hold it in an unallocated account, a pooled account, because who's to say that the gold is really there? And if that company were to go bankrupt, again, you have the problem of going through the court system in order to get or re-get control of your capital. Whereas an ounce of gold or an ounce of silver in your hand or in a private non-bank vault, you know it really exists, you know that it's real physical metal, and you have access to it. So basically what he was getting at is, as to the best of your ability, become your own central bank, become your own depository.
I put together, one of the largest copper companies, in the early 90s, 92, 93. And I left that company in 2000 and I dabbled around in the internet market and watched crash. NASDAQ, dropped 80% over a period of, 3 years from 2000, into 2003, which really lit up the resource sector. And that was when gold was, bottoming out in 2001, 2002 at $250 an ounce, and silver was down at $5 an ounce. And I wanted to get back into the mining sector, and then I looked around and I thought about putting a gold company together, but there was just so many gold companies around. And I'm a big believer in gold. I think everyone should have gold, but coming from a copper company, I'm really a supply-demand fundamentalist. And when I started looking at silver, I just was blown away by the supply-demand story. And we didn't have EVs back then. We didn't have solar panels back then, for the most part anyways. But I looked at cell phones. I thought cell phones was really the place. I remember when the first cell phone from Motorola came out. That's how old I am. So, I remember black and white TVs, color televisions, fax machines. I witnessed all this stuff coming into being. This technology, I want to ride the technology wave, because I'm a huge believer in technology and the advances that technology and the benefits technology brings to the human race. And I just thought silver was a really good way to play the technology race. And since then, we've seen now two big markets: the EV market, which is taking up over 10% of world supply, approaching actually likely 20% this year, maybe next year. But we're producing as an industry 800 million ounces of silver a year, but we consume 65 million ounces of silver and spread over 6 million electric cars. So you do the math, and I saw an article out of an analyst in London, and he's predicting that the solar panel industry is going to consume 140 million ounces of silver in 2022. I don't know what the electric car industry is going to consume, but you've got two brand new buyers of silver that are now consuming almost 30% of the world supply of silver. And these buyers didn't exist a decade ago.
Lithium market actually, like approximately 8 kilograms in one battery. And I was just like toying around with the math. How many vehicles are there in the US? How many are in China? How many are in the world? And then doing the math based off of where governments are making the mandates. And I do this math and I go, has anyone that is proposing these ideas done this math? And I think maybe Elon Musk might be the only one, because he got in trouble for, the supposed coup d'etat in Bolivia to try to control lithiums. And he also has they have a patent for lithium extraction. And I'm like doing the math and I'm like, geez, like the amount that is needed for the electric cars based off of these, pretty much all these big governments, whether it's EU, Canada, a lot, Gavin Newsom, they're pretty much all by like 2030. Well, there's 280 million cars just in the United States. There's another 280 million in China. There's over 1.5 billion cars in the world. And they say like they're all going to be electric by 2030, 2040. And I'm doing the math on lithium. I'm like I almost felt like a smart ass in the back of the class. Like, hey, has anyone ever done this math before? And when you're saying that about silver, it's amazing because it's the exact same thing. That's why I was always so much more interested in gold versus silver, because of these supply demand things. For someone like me who's not a rocket scientist, I can just look at the math and be like, this doesn't make much sense. And
that's why I say to people, we need $10 copper prices, we need $100 silver prices, because the miners need the incentive to make the investment. And the numbers that when during the lockdowns, I was doing research as well, and there's about 95 million automobiles produced every year. 2020 was obviously a low number, but on average over the last decade, that's approximately how many cars get produced each year. And there was only 6 million cars. 6 million of the 95 million were electric cars.
Wow.
Yeah. So if governments want to replace fuel combustion cars by 2030 or 2040, that's a big change. And you now see Audi and Volkswagen and BMW and of course the U.S. manufacturers as well. We're seeing more and more automobile companies producing electric cars. So that 6 million is probably a much bigger number, because that's a bit of an old number. But nevertheless, that's a ton of silver. And if it's about a kilo of silver per electric car. You'll never get that number out of the auto industry because they won't tell you. They're paranoid about telling you because they don't want anyone to know how much metal they're consuming. But to get a silver mine producing, it's a minimum of 10 years. So, and that's if everything goes really smoothly. So you drill a hole and you discover economic silver. You're going to drill it out over a period of 4 to 5 years to make sure there's enough silver there. At the same time, you'll be doing permitting, talking with the governments, trying to, get this thing done. Then you got to finance the darn thing. And then you're going to construct it. And constructing, depending on the size, is going to take anywhere between 3 to 5 years. So from first discovery, it's a minimum of 10 years.
Gold itself is a huge bargain. But when you look at the asset classes, this is the absolute biggest bargain. I believe that you should do what the smartest person in the room on any given topic is doing for themselves. So I'm always looking at that kind of thing. So, and it also kind of works like this. You go to but you need a diversified portfolio. No matter what I'm saying here, even within precious metals, it needs to be diversified. But let's say we go to an auction and there are 10 people at this auction and there's 10 coins on the table and everybody wants one. So wherever the bidding opens up, that's what they're going to pay and they'll walk away happy. But you have one coin and everybody wants that. So now he or she who's willing to pay the most for that coin gets it, but you still have 9 other people that wanted it, right? And there ain't no fever like gold fever, let me tell you. So again, and the premiums on these coins they're not as low as I've recently seen them, but they're still substantially below the historic norm. Where gold and silver physical are the biggest bargains, but even more than that, the collectible coins are, and you're not paying very big premium. But it'll depend. I mean, it all depends. So right now you own a couple of properties, but history tells us what happens to properties during the circumstances that we're in right now. And I mean, this rapid run up, I mean, if you've been in property for a long time, you know that that's not normal for the prices to go up like that quickly, right? So, and what goes up like that must come down and vice versa. So when that happens, those that are not prepared to hold on to their holdings, there will be a lot of properties that come on the market. And it does a flip-flop. So right now you got undervalued gold, overvalued real estate, and then that's going to flip-flop. And so then history also shows us that, and I did a whole piece on this, but 25 ounces of gold or the equivalent would buy an entire city block in Berlin, right, during the Weimar Republic. 25 ounces of gold, right? So, again, you go back to your goals. Maybe you just have a couple of rental properties now. Well, look at all the building that's going on. A lot of that is securitized. In other words, turned into securities and sold. Wall Street sells it to the public, right? They don't care if property prices go down. They've got their money out. Right. You're the one that's sitting there holding the bag. If you're 35 and you've got, a solid job that won't go away. I mean, frankly, I kept working all through the pandemic. I mean, it didn't stop us at all from doing what we're doing. So if you're in that kind of position, right, then you don't need, because you need some level of cash as well outside of the system, not in the banks, but outside of the system, you might not need as much. If you're older, right, then you probably need longer. But this is a discussion to where your personal level of comfort is. When they do an overnight reset, like we see in Venezuela, they've done 3, Zimbabwe, there are a whole bunch of countries that have done that. What they do is they revalue the currency against the gold, and then that's when it expresses somewhere near its true fundamental value. So how do you get that number? Well, you know how to do it with real estate, right? Because historically 10% return on your investment. So if you're only getting 4%, it might be a little overvalued. If you're getting 15%, wow, it's undervalued rock and roll. So everything has that, and that's where a little bit of judgment is. So going back to the physical, to gold and silver, the most important function of gold is to hold your assets even over time. And that's exactly what it's done for 6,000 years. With fiat money, the goal is really to give you an invisible tax that you don't fight because it doesn't have to go through legislation, and for corporations to pay you less and less. But the way that money is created is by debt. So Just to put it simply, I'm not going to get you to the penny. I'm not even going to try. I'll just get you close, right?
Yeah.
So you take all the debt that's been created, because that's a proxy for how much money has been created. And you divide it by the finite amount of gold that exists. You can use in-ground gold, above-ground gold, but gold is indestructible. So we can really, to be very accurate with how much gold there is, to 98%, and that's pretty good. So you just divide how much debt there is by how much gold there is, and that gets you somewhere around $13,500. And the more debt they grow, the higher that number goes. How many mortgage could you pay off? What might take you 10 ounces of gold to pay off now might take you a quarter of an ounce or a 20th of an ounce when that reset occurs. And that's part of the strategy. So there are different risks when you invest in real estate that you need to cover. And frankly, the best way to cover it is gold. Because what gold does, and I've done lots of studies on this, you know, real estate runs some risk. If you have debt on it, right, then you've got to be able to pay that mortgage. And as anybody that's in real estate has recently experienced, the rent moratoriums, the mortgage moratoriums, and these are the kinds of things that happen when we go into the area like we are definitely entering right now. They will put caps on what you can charge, but there won't be any caps on your property taxes, on your insurance, on your maintenance. No caps on those, but caps on what you can charge. So what gold as a diversifier does, because this is good money, and the dollars in this country anyway, but the government money is based on debt, and debt is at nosebleed levels. We know that. And interest rates are rising. So you need the gold to ensure that you can always pay your property taxes, and also for when we go into these periods like we saw in 2008, that wasn't that long ago, right? And if you got into trouble and you couldn't handle your mortgage, you couldn't continue it for any reason, then they restructured, they reset that mortgage. And if you were part of that, I'm pretty sure you realized that it wasn't really in your best interest. It was in the bank's best interest. So you want to have the ability to, boom, pay that mortgage off in a moment's notice if you need to do so. And that's why it's critically important that you have gold, particularly in your portfolio, to make sure that you are properly diversified. Because if all you hold are dollars, you know, they're destroying the value of the dollar.
Very possibly. I mean, it certainly leads to higher ruble prices and higher gold prices. I mean, the Europeans are kind of whining and saying, well, you know, we're not going to do that. And Russia's response was, okay, well, on March 31, we're going to cut off the gas. You know, we're not giving it to you for free. So you can decide whether you want to pay with rubles or gold, or no gas, you know, we'll shut the pipelines down. You know, to back up a bit, you know, I've said this in other videos, but just reiterate it. I mean, I think what just happened with, you know, Russia, and, you know, I no way condone any wars or any behavior on the part of these guys, and Putin's not a good guy, but what just happened with Russia, though, is similar to what happened to De Gaulle in 71. You know, the French really pushed us off the gold standard. They forced Nixon to abandon the gold backing at the dollar at the time at $35 an ounce. The reason is that you know, our gold reserves in the United States were getting, you know, drained very quickly, and Nixon realized that they were critical, you know, and so he said, well, I'm shutting that window. And so it's a little different, but it's similar, because I think what Putin did, I think he did the calculation, and he said, you know, these guys are highly levered. They need stuff. I'm a big provider of stuff. They're behaving in a way I don't like around a country that's a satellite of mine. They're, you know, potentially trying to get them into NATO and put missiles near my doorstep, and I'm going to hit them economically. You know, I'm going to basically say that I'm not going to sell my stuff. You know, if that's the way they're going to behave. And of course, you know, the minute he declared the war, the United States responded with huge sanctions and shut down the SWIFT system. But probably more importantly, I think it's really was an earthquake. I'm sure Canadians can relate to this, because what, you know, your Prime Minister Trudeau did to the truckers was kind of an earthquake. He just kind of said, look, if you're behaving in a way we don't like, we can seize your money. And Trudeau said that you support the truckers, we seize your money. I mean, that's no due process, no courts, no nothing. Well, the United States just said that with respect to, reserves stored in the Western financial system. So, obviously Russia had all these financial reserves, and we just said, nope, sorry, we're freezing that. And, it's one, it's breaking the law. Two, it's theft. Three, those are monies that they earned fairly. And so the war really is a kinetic war, obviously terribly sad, but on the monetary side, it's actually even more interesting because it's really a monetary war as much as it's a kinetic war. I mean, hopefully the kinetic war will kind of get sorted out and calm down. I don't know because of crazy people on both sides of it, but on the monetary side, it really is an earthquake because what Russia provides in terms of both oil and gas and food, wheat, and Ukraine as well, is pretty essential to the world functioning. You can't just take it all offline and expect the world economies to not have a serious problem, and they're going to have a serious problem. There's going to be, there's going to be a food crisis, I imagine, from what I can see. And I think Putin accurately calculated that the gold suppression, the Western gold suppression scheme, and that the Western fiat currencies were what have allowed the U.S. to kind of dominate the world and live at the expense of other people. I mean, the point that de Gaulle made was that, Americans have an exorbitant privilege. Everyone else in the world has to work to produce services or goods, to get $100, and the Americans can print one. And that's why, so Americans live better than the world as a result of that reserve currency status. And so my sense is what happened is Putin finally came to the conclusion, you know what, I've had enough of this. I'm not selling my real stuff for fake paper. I'm going to withdraw from the game. Let's see how you guys do. And the thing that's interesting to me is the West has reacted with demonize him. He's a bad guy. This will never work. We've got all the cards. But in fact, to me, it sounds like they kind of know that he's made a pretty powerful move, and they're whining about it a lot, and they're trying to demonize him. But the fact of the matter is, it was a pretty good chess move, and the West is going to have a serious problem in dealing with it. Is kind of how I see it, and it's enormously bullish for the sound money thesis, for the gold and silver thesis, because it's a sovereign nation, with nuclear weapons saying, we call bullshit on this fiat. That's what he's basically done, as I see it. So, and it's enormously positive. Short term, it hasn't been so great. I mean, it's kind of like, things are kind of bouncing around. We got a nice pop up above 2,000 a little while ago. It's correcting again, and this is pretty normal. I mean, I'm sure that the U.S. government and other governments have been printing paper gold and paper oil, to try and get everything under control and prove that they're still in control. But in the longer run, the markets are going to win out. It's paper gold is not real gold, and they're going to demand delivery and settlement, and you can't deliver paper. So.
The best decentralized finance you can have is physical metal. I mean, I don't care who you are and how sophisticated you are, and if you wrote code for your whole life, you still have a counterparty risk. One is electricity. Two is the internet. Three is if you're on an exchange. And if you're off the exchange and you got your code written down on a piece of paper, good for you. That's fine. I think that's smart. But you're still going to have to go in an electronic system sometime to transact. So nothing beats metal as far as having decentralized finance. As far as, as you're playing a game or not, I don't know. I really think that they don't know what to do. I know what they want to do, and I'll just outline it again briefly. They want control. They don't want to give up control. How to get it back is, as I said, do you ban it all? Do you make some? Do you convert it? What do you do with it? I think that a lot of them will just be banned. It'll be like the tech wreck in the 90s, where I think it was 99, where all these .coms were flying high 1 minute, 2 minutes later, they were off the board. They didn't exist anymore. I think that's a good analogy for what will happen in the crypto world. Does that mean they're all going away? No. In the tech wreck, Amazon, Yahoo, eBay, a lot of these things, are stalwarts now. But a lot of these, XYZ.coms are no longer in existence and haven't been since they, went away.
Do you think that a lot of these, recent events have changed the public's view towards cash as well, David?
Definitely think it's had an impact on cash. People get their programming from the TV, and the idea of cash is like it's not necessary. Then during the illness, it was dirty or it might carry the disease and all this stuff. So we've been moving toward a cashless society for a very, very long time. I'll give you a quick example, Tom. I mean, we've heard, my ilk, the hard money writers, the free market thinkers that have written in the, newsletter industry, and others, of course, have talked for years about the global currency. And, I was in, I think, Hong Kong, and I'd been through Europe. I've been through like 5 or 6 different countries, and I'm now standing there on stage in Hong Kong, and I held up my Visa card. And I said, there is a one world currency, and this is it. Because through all of those countries and all those hotel rooms and all those cups of coffee and all those, meals, I used that plastic card, and they did the conversion. I didn't have to worry about going down and finding their paper currency to transact business. So in a way, and that's been the theme, and it's convenient. And, I'm not saying it's even wrong. What I'm answering your question. Cash is not something that, is going to be around a lot longer. And of course, it's the most anonymous way to make a transaction. And that's what the bankers hate. When we go to a full digital system, they'll be able to track, trace, and tax everything you do. On top of that, there'll be an overlay of a social credit system, regardless of what they call it. Mm-hmm. And if they're telling you that you use too much carbon because you went out and drove your car too far, and you go in and you want to buy a steak, it's like, no, you got one or the other. You already drove your car, so you can't get a steak. You got to have this, this stuff that we create, call it food, and that's your only choice. So it's a top-down control mechanism run primarily. And I'm not sure of this. I've had guests that I've interviewed, and I'm not smart enough to know. I should probably get Cliff High and ask him, because I think his opinion's better or different than mine. But I know there's some AI involved. To what level, I'm not sure. But there's no one entity, or there's one guy behind a computer that controls all this stuff. It has to be programmed. Mm-hmm. And of course it is. So it's very scary, but yet, again, it hasn't happened yet. But the direction's clear. And this is like, Catherine Austin Fitz has said, it's my words, not hers. It's now or never. I mean, you've only got maybe, I think her words were a year and a half or something. I'm in line with her. I don't think we have, time's running out. The hourglass sands are not many at the top, most are at the bottom. And you've got to, do what you can. And the best thing you can do is say no. And that's hard to do, especially if you're in a food crunch or a money crunch. You lost your job and your savings is gone, and you still got to pay rent. I mean, I get it. And this is under the main agenda, to put the hurt on the people of the planet. I mean, if there's any war against humanity, it's what the elites are doing toward humanity, at least in the aggregate. Are there some elites that are good people? I'd like to believe so, but I've not been convinced yet.
If we understand what's happening, I think we do, we're going to stay on the right side of this. We just got to ride this out. I don't see anything major here. It's not an epiphany that we're having issues in the yield curve. I mean, I'm not surprised. I don't think you are or anybody else. This is just a reflection of what is going on despite the propaganda. Period. The end. I pretty much am ignoring it. I'm focusing more on the 10-year yield. And right now, I don't see any red flags anywhere. I think the market is going to continue to get propped up by more debt. And I think oceans of it are coming, much more than we've ever had before. So that's my take on what's happening with regard to the yield curve. I've been telling my people, just don't worry about it at this point. I don't see anything going on.
So do you think that debt, that ocean of debt that you're referring to, that's going to come through more government spending? Are you talking about the sovereign balance sheet or the corporate balance sheet or the consumer balance sheet, or what do you think?
Well, I think from right at its core, it's central banks who are going to continue to fuel it. They have to. You know the mechanism here. It's very, very simple. They must continue to inflate. They've been doing this since forever. They're not going to stop. It's the mechanism to continue the debt-based economic model from functioning here. People are obviously, consumer debt, household debt taking off like we've never seen before. Inflation is skyrocketing. It's a very, very bad situation for people. Unfortunately, people are being pressured from every possible direction and then some. And in my view, I don't see an end in sight here. I don't see it because I don't see the mechanism changing at its core. It's going to continue the way it goes. It's going now. I just until we hit that climax here, the grand finale is, to me, and I would imagine yourself, is the debt market. The debt market is going to implode. I don't know when. I don't even care when. I really don't. I'm just, taking advantage of things as I see opportunity come along here. I think the fact that this is being prolonged, like every other crisis is, gives people who have a few functioning brain cells the opportunity to get themselves on the right side of it before we get the implosion in the debt market, which is going to wreck the stock market. And then we're just going to see cash move from one set of assets into another. And we're already seeing it to a certain degree. We've seen commodities take off, although we have had a big pullback recently. But I think that's just a temporary, that's the way the market works. No asset class, no asset goes straight up without a little drop or a big drop, and you get a new floor and then we go higher. Because the debt is going to continue to inflate. That's the core. In my view, I look at things this way. I look at the debt market as the driver of everything. Now, because the debt market is the largest part of the market by exponents, everything derives value from it. So we have a debt market hyper bubble, which is out of control. It's going to get much, much larger, faster, I think, than we've ever seen before. We're going to get other assets continue to inflate, and certain things are going to deflate. For example, we're seeing the absolute value of the dollar crater. It's going to continue to crater, unfortunately, and I think it's by design. It's a mechanism. I think we all expected this to happen, although I do expect the relative strength of the dollar to stay high, and it has. It will. For the foreseeable future, unless some other massive force acts against it, and that would be, obviously some kind of a world war maybe, or something along those lines.
Everything you buy will go from your Fed coin. So exactly. right now, $10,000 is the limit to how much money you can travel around with, and it's been the limit for 35 years or so. And let me tell you, $10,000 is nothing. If you fly over to Geneva and you spend 2 nights in a nice hotel, couple dinners, and a day of skiing, you've blown through the whole 10,000. So it's absolutely not an amount of money that amounts to anything. So you're already here. Lunch in any major town in America for 2 is $100. Okay, so the money has already slowly been digitized as we speak. You cannot move money around without going through the Fed system. And next, the Fed's going to say, okay, but this crypto is revolutionary, and we're going to use the backbone of crypto to implement FedCoin, which is going to be so great because you'll never be able to not pay taxes again. By the way, eBay, someone told me the other day, eBay, if you sell your old iPhone for more than $600, eBay sends you a 1099 as of January 1, and PayPal and Venmo and Zelle send you 1099s, okay? And the person telling me this said, can you believe it? And I said, not only can I believe it, you ain't seen nothing yet. This is going to be every single dollar that moves. They're going to track that, and you're going to pay.
And the question is it unstoppable at this point? We see the executive order coming from President Biden. We see the notes. If you read the Fed meeting, it is in there that they are looking at this, and it may be coming sooner than we think. But is it unstoppable?
Yes. And when they tell you it's being thought about, it's already been done. Okay? Believe me, these people are not concerned about your individual liberty. They say, why would you want to hide anything? Do you have something to hide? You know, are you up to something? Okay, why don't you want us to see what you're doing? And everybody needs to understand, you have this crypto boom. Everybody's enamored with crypto. Okay, for years and years I've said this, and I wrote it in a book, and I wrote it in Doug Casey's newsletter, is that the crypto boom has nothing to do with FedCoin. Okay, because you have a bunch of pancake coin and you think that you're going to be rich because it's going to be worth tons of money, that's different from what's happening with FedCoin. That's not going to have anything to do with pancake coin, okay? This is going to be something that's a closed loop blockchain that the Fed controls, and it will track and trace every single dollar. You know, look at your dollar, serial number on the dollar, okay? That's going to be listed on a blockchain. You ever play liar's poker with money? All those serial numbers, like that, they already have the serial numbers. It'll just be digitized on a blockchain, and every dollar will be tracked. So back to your original question. So E.B. Tucker goes and buys another car, and the Fed coin doesn't work, and they say, well, you have too many vehicles. You know, how many people do you have in your house? You know, it's too many. Or you have to pay an extra fee. Would you like to have more than one vehicle? You got to pay a fee to have more than one vehicle. How many square feet is your house? Mine's very small, actually. I'm a small house person. I like to live in a small one-story, architecturally cool place. But many people like to live in a gigantic home with columns and chandeliers and gaudy fixtures everywhere, and those people are going to pay through the nose because they're going to say you don't need 7,000 square feet for 3 people, and all this is trackable, traceable. It's right on the horizon, and there's no way you can stop it.
Let's say the day that it comes, right? Is there a workaround around? I don't want to use the Fed coin. What else can I use? You can get yourself a vertical farm in your living room and try to survive without using the Fed coin, but good luck to you. My suggestion is, number one, is if you have why gold, why now? I mean, first of all, if you haven't read that, I mean, I think you're really missing out, but it's not too late, okay? Because I explain 2 things. I mean, one, I lay this whole path out, and you can see that it's all coming true as promised. And then 2, why don't you make some money off of it? Because a little extra walking around cash is going to help you deal with transition pretty well. Imagine when your friends were laughing at Tesla, if you had gone home and look at Elon Musk. I mean, all his stock options he's exercising, he's up 1,000% or better because he positioned early. So instead of laughing at the greenies that are driving the electric vehicles, if you had said, wait a minute, these guys are onto something. I mean, we're not going to use oil. We're not going to buy it from the same people that we used to buy it from. We're going to use battery-powered everything and renewable powered everything. And maybe I should learn about this before it's too late. Those people, they have a name for them. You know what they call them? Millionaires.
Debt is pulling consumption forward from the future. You borrow money that you don't have to consume something today. So, and that's in and of itself inflationary, but the debt remains and you have to pay it back. And so you've got to make more money to pay the debt back. And so if there's not a continual flow of new money into the system, the debt starts to default. And so these are what we call classical credit cycles. And there've been many, many credit cycles. I mean, this story is as old as man. I mean, these things were happening in biblical times, you know, people would, and this is why the whole concept of the debt jubilee occurs, because people just get so indebted they can't pay it back anymore and the debt collapses. And so, you know, this is what happened in the 20s and 30s. We had a big bubble and a debt collapse, and here we are 100 years later, and sure enough, we're going through the exact same cycle. And in the 20s and 30s, what they did was they confiscated the gold and they reset the gold price, so they created some inflation, and then they built off of that base, and they had a sound money base because they were on a gold standard. We don't have that today. This has happened in many countries throughout the world. I mean, people who live in South America or Argentina are very familiar with this. They've had many debt crises, and more recently Venezuela had a debt crisis. And you know, it's what it really stems from is politicians thinking that there's a free lunch and spending more than they collect in taxes or more than the economy can handle. And they borrow to do that. And then in order to make the borrowing not go bad, they print money to pay the interest on the debt. And so if you kind of consider the world is the world, and there are a bunch of people in it, and there are a bunch of factories, and there's what we call goods and services. And you know, the amount of goods and services in the world grows every year based on either population growth or increased productivity, but it doesn't grow massively. And so, the dollars or the paper currencies that we work with are a claim on those goods and services. And so if you start issuing more dollars into the system on a regular basis, each dollar buys less. It's just classic monetary debasement. And what happens is eventually in a credit-based system, the structure of the credit gets so large that it's just obvious that either the printing has to become incredibly large in order to keep the system going, and therefore the dollar value, each dollar becomes worth a lot less because there are more of them in circulation. Or the debt has to be, the debtors say, well, pay me back, in which case everybody has to cut back on their spending in order to pay the debtors back, and you have a debt collapse. So you get either massive deflation, which is what we had in the 20s, or you get massive inflation, which is what Venezuela and Weimar Germany and countries that spend too much have. And honestly, our situation could go slightly either way, but I think we're going to trend towards the inflationary side because I think the government and the Federal Reserve have more or less said we are not going to let this economy fail. If things start to turn down, we've got enough money, and the prevailing belief in government and many economic circles, particularly with these new MMT people, is that we can print the money. Don't worry about the money, we can print more. And they're right, they can print the money, they can give everybody the money to service the debts. I mean, look at what they did, in March of 2020. They sent checks to people, they put money in companies, healthy companies, they gave money and said, as long as you don't fire anybody, you can keep this. I know several companies didn't need the money, but they took it because it was given, and it was just a government grant. And so, they can create the money to keep things going. That's the good news from keeping things going standpoint. The problem is that when you grow the money supply 40% in 18 months, which is what happened, you've got now 40% more dollars chasing the same amount of goods and services. And guess what? The price of those goods and services is going to go up because there's more dollars chasing it. It's just a supply and demand issue. So, and this is why you see, and people react to it too. This is why we see housing prices up 20% year on year. One could make a strong argument that that's an intelligent thing for people to do. You need a house, house has a certain cost. You don't want the house, the house is going to go up in value over time, and you can borrow against it at a subsidized government rate. So here you are, you get to buy an asset that's going to have value for 20 or 30 years, and you get to borrow money at 3% to do it. And that asset's increasing in value. Last year on year, a lot of house prices went up 20%. That's a really good deal. And so that's classic inflation. Now you ask, why does it have to end? Because the math just becomes too extreme. Because, because it's just so far out of whack. Part of what keeps these things going is interest rates are falling. But, as many people know, we had negative interest rates in Europe, and we had very, very low interest rates here. We had zero interest rate policy for many, many years. So interest rates can't really go negative. So, interest rates have fallen about as much as they can. The debt level has gotten about as large as it can get. The economy is kind of chugging along, but it's not like it's growing fantastically to pay down the debt. And absent some huge, productivity miracle, like suddenly somebody invents cold fusion, and, we don't need oil anymore or something, which is unlikely. There's really no way out but to either, you either let the debt collapse, which is possible, or you print the money to service the debt, which is fine, but that's why gasoline will be $5 soon, because you printed the money to service it. That's why oil is making record highs in the mid-90s right now. And so it's just math. There's nothing really magic about this. And these cycles, if you study history, these cycles have occurred over and over and over again. And the reason most people aren't familiar with this, they don't understand it, is that most people don't study the history of the 1920s and 30s. There's nobody alive today who lived through the last one of these, because the last one of these happened in 1920 and 1930. And, the people who were alive then and were investing then, they've all passed away. And so, human beings, we go on, we repeat the same mistake. And here we are.
I think that what has happened is that there has probably been intervention by governments, and I think particularly the US government, maybe with a little bit of help from elsewhere, to try and calm down markets. I mean, we've known in the past that they intervene in the gold market. That, that is recorded history, and there are many, many instances of that. But I think particularly we've seen it in the energy markets, as well as maybe in the metals markets. And this, I think, is why WTI fell from a high of, $135 down to around about 93 yesterday. And it's a little bit better this morning. So to my mind, this is, there is this interest, if you like, from government to try and calm markets down. Now, where we are in this is that so far, Putin has not responded to Western measures to sanction all Russian bank payments and sanction various individuals. The problem Putin has is that even with a settlement, with a settlement, he can turn around and say to his people, the special operation has succeeded. But you've still got the problem that the West is not going to back down on sanctions against Russian payments. So he might respond. Now, he might take the view that actually the West is killing itself with these stupid sanctions, and he just stands back and just watches them get into a huge, great mess. That, I think, there's a logic in that strategy. On the other hand, he might come back in certain respects and make life very difficult for us. And I suspect that could be, he will turn around and say, well, because of the effect of the Ukrainian special operation on grain output, we're not going to permit grain exports from Russia. So, he could tighten up the thing there, and he could argue it on the basis that he's got to feed his people first. So that's one thing. I think he could maybe do something with some of the rarer metals, sort of platinum and some of the rare earths and so on and so forth, saying we're going to restrict these because we need them for ourselves. And the great thing about that is that the public have got no interest in precious metals. They understand oil and they think, my God, my heating oil's gone up. This is because of Putin. So, that I think is a different category, if you like, of geopolitical strategy than, say, rare earths, palladium, whatever. So there are things he can do to make things difficult for us. And I don't think the oil story is necessarily over either. Yeah. So, this idea, what we've had, so what I'm saying is that we have seen this, the initial ramp up in prices as everybody got caught short, and of course the hedge funds ran in and sort of said, sell dollar, buy gold, sell dollar, buy silver, whatever they were doing on the futures market. The problem with this, I think, is that having had that initial run up, and then I think that the authorities, if I can say that in the general sense without being specific, have tried to bring calm back into the markets. I think there comes a point, maybe in the next week or two, where we start seeing prices rise in a more orderly fashion, really driven by, and I come back to this, by all the money printing that's been going on over in recent years. So the idea that this is, the price of gold and silver have suddenly been really sort of hit and it's terrible and, you've got to bail out and all the rest of it, that's for idiots. It really is. The point is that silver has an enormous role to play in this world of environmental, whatever, because of, it is the best conductor in the world, bar none. We have seen what's happened to uranium. We have seen what's happened to lithium prices. Why hasn't it happened to silver? The answer is they're sitting on it. They're sitting on the price because the bullion banks are short and they can't afford to see the price go up. Yeah. And, so it's not going to take very much to actually tip silver, I think, into the sort of squeeze which we saw very dramatically with nickel. I think that is, for the establishment, actually quite a significant danger. So,
but you think they just changed the rules? Will they change the rules on COMEX?
Well, yes, of course they will. Yeah, of course they will. I mean, I remember the Hunt brothers. You know, I was a young stockbroker in those days, and I had a client. I had a client who was dealing in South African gold mines, and he was also writing options, selling options in the silver market, and he got wiped out. Fortunately, I didn't shoulder any losses, but my commodity dealer friends went out of business because silver moved more in one day than it had in the whole of the previous year. You know, and that's the sort of situation which the establishment wants to avoid. I mean, they'll move heaven and earth to avoid it. So, I mean, does this mean that we should think that the establishment can continue to always control the situation? We should go and look at something else? Well, you could do that. As an investor, I think it's actually could be quite sensible. But if you are actually trying to get out of the fiat money system and hedge your total commitment to the fiat money system, then what you should do is you should have some physical gold and physical silver, because that is real money. And you don't buy it to invest, because by definition, an investor buys at one price in the hope of selling it at another price.
Understood.
What we're talking about is we buy it so that when fiat currency falls over, we have got something to spend. And that is really what the role of physical silver and physical gold should be in the monetary sense.